welcome to the Money Show, your one-stop destination for all personal finance queries. I am Snehi Shah. You're watching ET Now. We have a power-packed show lined up for you today, and joining us in the first segment is Mrin Agarwal to talk about how to plan your investment strategy if you are someone with a high-risk appetite. And in the second segment, we will throw open the counter to get your mutual fund portfolio queries answered. So viewers, remember, do send us your queries on our WhatsApp number 865-797-4571, or you can also email us your queries on the Money Show at etnow.tv. But with that, let's dive into some key aspects of investment strategy that can shape the way we approach long-term financial growth. Now, whether you're an experienced investor or just starting out, understanding the fundamentals of risk, diversification, and portfolio management is crucial. Setting strategies for building a diversified portfolio, avoiding biases, and setting realistic return expectations is also important when it comes to long-term financial planning. To understand and decode all of this, let's welcome on board Mrin Agarwal, the financial educator and founder at FinSafe. Hi Mrin, thanks so much for joining us. First of all, wishing you a very happy new year.
Thank you, Snehi, and happy new year to you as well.
All right, then on that note, let's get started with all the questions that need to be addressed when it comes to investing for people with high risk appetites. The first one that I want to ask you is, how can long-term holding strategies, typically for 10 to 15 years, be balanced with the volatility that is usually seen in the markets at present, especially during economic downturns? And how important is diversification when it comes to managing risk effectively?
So firstly, for investors who are looking at investing in a high risk strategy, I think, some of these basics that you talked about, like, for example, diversification, long-term holding is very, very important because, one of the things that can really help with, with the volatility really is the long-term holding, right? So if you do intend to have a high risk investment strategy, I think it's really important that you should have a 10 to 15-year investment horizon. And also within this, you need to diversify. So even if you're just going in for small caps, you need to look at different strategies around it and not just look at putting everything. Like, for example, these days I see people, putting everything in like one Nifty 50, Nifty 200, 250 small cap fund, right? So within this segment also, you will have to look at how you can basically diversify, and you have to always keep these basics in mind. Of course, there is going to be a lot of volatility in this particular strategy if you're following a high risk strategy, and you need to be prepared for it. So it shouldn't be that you're getting into this strategy, but then you're at the sign of some volatility, you say, I want to get out, right? You need to be prepared for the long term. You need to be prepared for the ups and downs.
Okay, Mrin, thanks for that. Also tell us, what's the difference between risk-taking capacity and risk-taking ability? And how should an investor assess their own ability to take and handle risk?
So see, first and foremost, the risk-taking ability is like saying that I've got 100 rupees to invest and I'm ready to take any risk, to get this money to grow. But risk-taking capacity is really about, can you actually afford to lose that money or not? And can you actually handle the illiquidity? So you might be willing to take risk on this investment. Like, I have seen a lot of investors in the recent past who want to play catch up, who've never invested in equities, and all of a sudden they want to play catch up. They want to get those great returns. So they're like, I want to take now a lot of risk and I'm ready to put my money into risky investments. But the question then still remains that if you were to lose this money, what would be your reaction, right? Because a lot of people who are coming into these risky investments believe that they're only going to make these 15, 20, 30% returns and that they're not going to have losses. So if you're going to have a loss, then what is going to be your reaction? Are you going to be able to bear this loss or not? And the other bit is on the illiquidity. Like, for example, if the markets are down and obviously you would not want to exit at that time, and to that extent your investment becomes illiquid, then, how is that going to impact you overall? Like, can you live with this illiquidity, or do you actually need access to the money? So the risk taking capacity is really about all these other factors, and not really that I'm willing to take risk on this particular investment right now.
Okay, that's very well explained, Mrin. Thanks for that. Also, tell us, very frequently we see people falling prey to some biases that are existing psychologically. So how can investors avoid common biases? Like, you have the likes of recency bias, there's the tend to get onto the bandwagon, so the herd mentality comes into play. You have a survivorship bias that comes into play, particularly during a period of downturn in the markets. So tell us how to avoid falling prey to all of these biases. And also, when it comes to speculation, a lot of investors have a habit of speculating without understanding the technicals or the fundamentals of a stock. When it comes to long-term planning, what kind of room or how much space does speculation have in this process?
Yeah, so of course, herd mentality is seen very commonly. The recency bias, where we are basically only looking at recent information. And of course, there's survivorship bias, where, for example, we are looking at success stories, or we're looking at anecdotes. And unfortunately, we have a lot of that today, in social media in forms of reels and shorts and stuff like that. And everybody is looking at that one tip, that can really help them multiply their money really fast. So I think, obviously any decision that you make needs to be a well-researched decision. And I would also like to say that the source that you're looking at your information is really important. I mean, unfortunately, the reels and shorts have become the source of information, and this cannot be a source of information. There is enough data to prove. In fact, I recently read that, somebody did this analysis where over the last 3-4 years, they looked at all the recommendations given by financial influencers, and they found that over 70% of the recommendations that were given actually did not make money. So I think, WhatsApp or Telegram, or, the social media is not the place to look at for the information. And certainly, these anecdotes and headlines are certainly not the way to go. You do need to research properly before you get into any long-term investment.
Okay, well, let's also address some other questions when it comes to asset allocation, because once you've understood how much risk you can afford to take, the next step is to start actually investing. So how should investors adjust their allocation between small cap, mid cap and large cap funds based on changing market conditions or personal financial goals as well? Even more importantly, considering this is for the longer term, so how do you put your eggs in different baskets perhaps?
So it's a very simple formula, right? I mean, if you know that you can hold money for 10 to 15 years, if you have 100 rupees, you need to figure out how much you're willing to put at more risk and how much you want to put at lower risk within the equity space. So obviously, small cap, mid cap is going to be higher risk. Now, for someone who wants to follow a high risk strategy, I actually recommend that you do manage investments, and I do not recommend you to do stocks on your own, because again, it's honestly very difficult for individuals to figure out what to buy, and more importantly, when to exit. While we're talking about products that I don't recommend, I do see a lot of people veering towards F&O. And of course, we've seen the recent SEBI data, which again shows that I think more than 90% of people actually lose money in F&O, right? Same thing goes for regular trading as well, right? So again, I do not recommend. Also, some other trending investments that are making money right now, of course, are cryptocurrencies and forex trading. So I wouldn't recommend all of these, because again, these are not really investments that you can actually hold from a long-term perspective, right? So I would say that go in for managed investments, like professionally managed investments. And of course, in this, you have mutual funds that are available. You've got PMS. You've got the new alternative asset class that's going to be coming up soon as well, where it's like a mutual fund, but they're allowed to do certain high risk strategies. So, as and when that comes out, one should also look at studying that further. But within the mutual fund space, I would suggest, I'm sorry, again, within the managed portfolio space, what I would suggest is that break it up into the core allocation and a tactical allocation, right? So you have the core allocation, which is invested in mid caps and small caps, mutual funds, of course. And then you have the tactical allocation part, which is basically you can look at the new asset class when it comes. And of course, you have PMS also available. That is provided that you have, those minimum amounts to invest. Now, when we look at the mutual fund space, even within the small cap and the mid cap funds, I would actually recommend the actively managed funds, because there are some really good actively managed mid cap and small cap funds that have generated alpha and beaten the index. And again, last week I was seeing this data on performance of the various indices over the last 10 years. And if you actually see, the small cap index has actually given a lower return than the mid cap index, but that's not the case when you choose the funds. So I would say, very clearly stick to managed investments. Within this, have a core allocation to actively managed mid cap and small cap funds, and have a tactical allocation amount that's available for strategies that are not available within the mutual fund. So there are a couple of PMS strategies that will be available, and these strategies are not available in mutual funds. So look at managing it like that.
Okay, that's quite the interesting anomaly coming in over there, Mrin. But lastly, what would you say would be a realistic expectation to have when investing in high-risk assets for the long term? Because since we're parking money for the long term, investors usually tend to get a little bit greedy. So what's a realistic target to have? What's a good expectation to have to avoid disappointment at a later stage?
Well, I would say look at a 12 to 13% sort of a return. Again, this last 10-year number that I'm quoting on the Nifty 250 is, I think, 13%, right? So I think like a 12 to 13% number is a good number to really go with.
Thanks so much, Mrin. On that note, we'll let you go. And viewers, I hope you have got a better understanding of how to invest in high-risk assets for the long term. Mrin, thanks so much for joining us. But on that note, viewers, we'll slip into a very short break on this edition of The Money Show. And on the other side of the break, we'll begin addressing all your mutual fund-specific portfolio queries. So you keep writing to us and stay tuned to the show. We'll be right back.